Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday stock market updates coming to you every Monday morning, 9 a.m. to get you ready for the market, get you ready for this week, what to watch in the stocks, the news, and everything you need to know. This week, it's kind of a wake-up call, time for a reality check, something that nobody wants to admit about the stock market. You know, professional analysts, individual investors, all kind of in denial about the stock market crash and what it's actually going to take to end this all and see stocks start going higher. So in this video, I'm going to reveal, how the stock market crash ends, what it means for your investments, and really how to invest in this over the next few months and even into the next year. Stick around though, because after that, we're going to have our Monday market updates with all the stock market news, the trends, the stocks I'm watching this week, and everything you need to know to get you ready. So be sure to join the community and hit that subscribe button and stick around for that. Before we get started, I want to personally invite you to get the weekly Bowtie. It's our weekly newsletter. Absolutely free, goes out Sunday night before the market opens, gets you ready for that week with all the stock market news, the strategies, the trends, everything I'm watching in the stock market. It's absolutely free, just something I like to do for all you out there in the community. So look for the sign up link below. But back to this week's topic, that stock market crash and what it takes to end that. And I think the Friday's CPI report, the Consumer Price Index report, that's CPI inflation, was really a wake-up call for a lot of investors that inflation isn't going away anytime soon. I commented last week that even as that moderation in inflation was happening from March to April, it just wasn't fast enough. Okay, so CPI inflation, consumer inflation did come down just slightly from 8.5% in March to 8.3% in April, but it was just not fast enough to change that rate hike picture by the Federal Reserve. A lot of the inflation pressures actually increased last month, and a lot of those upside factors aren't nearly as temporary as a lot of people would like to believe. Now, if you didn't see that report, the CPI showed that in May, on a year-over-year basis, inflation surged by its most since 1981, okay, for 8.6% year-over-year inflation increase. Energy prices were up 34%. Food was up 12%, rents were up 5.5%. And for all of you out there, you know that these government reports, it feels like inflation is going a lot higher than that, right? The market had been expecting inflation to come down a little bit to 8.2%, again, from 8.3% the month before, and then 8.5% in March. So it was a really surprise increase in inflation that made the markets fall, 3% on the day. And now with consumers and businesses fully expecting that inflation to continue, that we're kind of in that vicious cycle of inflation war and expectations, right? People expect prices to keep climbing higher, so they're going to slow their spending a little bit, and they're going to be asking for wage increases. Companies, for their part, expect costs to keep on going higher. They expect those wages to have to keep on going higher, so they're going to be raising prices as well. And all this kind of feeds into that vicious cycle, that self-fulfilling prophecy where inflation goes higher because everybody expects it to, and they're asking for wages, they're raising their prices. And now in this scenario, the only way inflation actually does start to come down is what a lot of people are calling, a drop in demand and, a little bit loosening of the labor market. And they say that because to say what they really mean and what it really means would be just too scary. And that is in a recession. Okay. And pundits, the pundits on TV and on the internet, they talk about this thing like a drop in consumer spending, maybe a tightening of the labor market, so weaker jobs numbers. Like it can be just a little thing, right? So like you can tell people that, we need you to just come back on your spending just a little bit. On the corporate side, we need you to stop hiring just a little bit. Like you can do these things just a little, right? It just doesn't happen that way. It's a little bit like getting pregnant, right? You don't get just a little pregnant, you get all the way pregnant, okay? And for a lot of these things, once hiring starts to slow down, then obviously that's going to have big ramifications for spending, for how people actually think about the jobs market and their own consumer spending. It's going to slow it down very quickly and very abruptly. So I want to show you something. This is the CME FedWatch tool, and this is the CMEgroup.com. It's the FedWatch tool. If you type that in Google, you'll find it. And basically, this is the market probability, the market estimates for how much the Federal Reserve is going to raise interest rates at each of its meetings. So if you go over here, you see across the top, you see the meeting dates for the Federal Reserve. We've got one coming up just this Wednesday, and we'll talk about that. We've got another one in July, September, November, and December of this year. And again, these are the probabilities. So 70% that the Fed funds rate, so the rate set by the Federal Reserve there to kind of affect the economy and affect all other interest rates, the market is pricing in a 70% chance that the Fed raises that to 125 to 150 basis points. And that's all, 125 basis points is 1.25%, right? So 70% chance that the Fed raises rates by 50 basis points or 0.5% to this number. Now, I actually think that there is a very good possibility, and now 30% of the market agrees with me, that the Fed could actually go kind of a shock and awe and increase rates 0.75%. Okay, so 75 basis points in this meeting come Wednesday. If not this Wednesday, then definitely one of the coming up meetings, just to really tell the market that, hey, they are serious about lowering inflation, slowing the economy enough that we do get, a little bit less pricing pressures. Now, if we click on the July meeting, we can see that investors or the market is pricing in about 52% odds that the Fed raises another 0.5% to 200 to 225. Now, there are some that are holding out hope that they only raise it by 0.25%, right? Which those people, they're living in la la land. I do not know how you expect the Fed to lower inflation from 8.6% on a year-over-year basis by going slow on raising interest rates. So these people are just a little bit delusional here, but we got about half the market, about 52% odds that the Fed goes 50 basis points this Wednesday, another 50 basis points in July. And then if you go out here to September, you'll see again, there's about 46% chance they raise it another 0.5%. And then, you've got the probabilities are diverging a little bit because some people think they'll go a little bit slower. Some people think they'll go a little bit faster. But you get generally, if you click through to these, you get generally about a half a base or a 0.5%, 50 basis points increase at each meeting, throughout the year. So by the time we get to December, 14th of December, that the last meeting of the year, we get about a 35% probability that rates are above 3%. Actually, about a 96% probability rates are above 3%, even a 28% probability, according to the market, that rates are 3.5% or higher. Now, understand, folks, interest rates, this Fed funds rate started the year at 0%. Started the year from 0 to 25 basis points, and we're talking about raising rates 3.5% in 1 year. And that is just an amazing jump in interest rates. It is really going to choke off economic growth and lead to a lot of the things we're talking about here. This lower hiring by corporates because, they're looking at borrowing costs that are going to be 3.5% higher. We're going to have higher credit expenses. So these interest rates are going to flow through to all interest rates, including those credit cards, those consumer loans, a lot of those kinds of things. So that's going to slow consumer spending very, very measurably. And again, a lot of investors, a lot of analysts and pundits still kind of in denial about what this means and that maybe the Fed can orchestrate kind of a soft landing, so to speak, right? That they can do this in a way that it doesn't choke off economic growth and doesn't slow the economy so much that it pushes us into a recession. And again, it's just denial. It is living in a dream where the Fed has a perfect record of being able to slow the economy down just enough, but keep us in growth. And it just doesn't happen. If you look at the history of the Federal Reserve as they're raising rates, they almost always put us into some kind of a recession. And we've never been at this level of inflation and this low employment rate, right? So they have to slow the economy down enough. They have to hit this jobs market hard enough that brings inflation down from 8.6%, right? The last time inflation was this high, back in the 70s, back in the 80s, then we had much higher unemployment, right? So they could actually, they didn't have to hit the market quite so bad because unemployment was already high. It didn't take as much to bring inflation down. Now they need to hit it even harder with those higher interest rates And there is just no way we're going to avoid a recession, probably into 2023. Now, what does this mean for investors? Obviously, that the market is probably going to be falling for a little while longer, at least. You know, we did get about an 11% bounce in the S&P 500 or in the Nasdaq, a 9% bounce higher in the S&P 500 from that May low. I was expecting that. We've been talking about that summer rally. I was expecting it to last a little bit longer though, but it does look like with that CPI inflation report that the market is probably heading lower right now and going to head quite a bit lower. Average bear markets back to the 1930s have averaged 28%, but those are kind of skewed by the bear markets, the crashes that were not followed by a recession. The bear markets that were followed by a recession have averaged actually between 30 to 50% lower from the peaks. Okay, the S&P 500 is now down about 19% from its peak of last year. So if we're heading down 30%, that would mean we have a lot further to head lower. Morgan Stanley's estimates or expectations or call for a bottom about 3,400, which would be about a 30% drop from last year's peak. And I think that could actually be the best case scenario we have to look forward to. So 3,400 on the S&P 500. We could see 2,800 on the S&P 500 by the time stocks actually find a bottom. Now, as for how to invest in all this, I can share how I'm investing and how I'm preparing for this as stocks do go lower by the end of the year with the money I've got in cash and bonds right now, as well as the money I invest every single month. I should be around 20 to 25% cash, savings bonds, and bonds in my portfolio, right? And again, we covered I-bonds a couple of weeks ago. One of the best investments right now for investors, helps you protect 10% or $10,000 of your money for each person in your family. 9.6% guaranteed return on those Series I savings bonds. Check that. If you haven't seen that video, definitely check that out. I'll link to that in the video description below, because again, it's one of the best investment opportunities right now for an investor. Guaranteed almost 10% return. It's going to protect your money for a year or more, and really great opportunity. I've also got some of the short-term bonds. I wouldn't be putting a lot of money in longer-term bonds because those are going to continue to fall as interest rates increase. But short-term bonds are a little bit more protected from that. So if we look at something like the Vanguard BSV, the ETF, that short-term bond ETF, that's only fallen by about 5-6% this year against that 19% fall in the S&P 500. Right? It does pay a good dividend yield there. Plus, you get to protect your money a little bit from the falling stock prices. Of course, I also have money in direct real estate as well as those real estate investment trusts, those REIT stocks for that diversification, along with some money in stocks in utilities and consumer staples. Those traditional safety sector stocks. Stocks in the consumer staples sector, only fell 28% in the 2008 crash, which was still a kind of a hard pill to swallow, but a lot better than the 55% plunge in the broader market, right? So, not saying that these stocks in utilities and consumer staples, which we can look at those when we do our sector watch, not saying that those aren't going to fall a little bit more as well, but they are going to protect your money from some of the other sectors, some of the other stocks that are going to fall much more. For that cash in my account, and again, by the end of the year, I should have at least 20 to 25% of my wealth in cash there. And again, I think it's very important to point out here that I'm not just completely stopping investing. I'm not stopping those monthly checks that go into my investing account. I'm just not investing them in any stocks. Okay, I think it's very important to keep that habit of continuously putting money into your investing account. Just let it sit there for those better opportunities to come. But keep that habit, because I see so many investors, panic out of the market. They sell their stocks, they take their money out of their investment account, and then they stop putting new money in it. And what happens is they just wait way too long to get back in the market. They'll wait for a year or more to get their money back into stocks. And by then, they've missed out on a lot of the bull market rebound when we do eventually get a turnaround in stocks. So keep depositing money into your account. Just let it sit in cash. And for my part, for what I'm doing, I'm waiting until the S&P 500 reaches 3 levels, really, with that cash. If the S&P does hit 3,500 on that index, it should be about 27% down from the peak of last year, be about that average bear market level. Then I'll probably invest about a third of my money in my favorite long-term stocks, right? If the S&P falls further to 3,100, which would be about 35% down from the peak, I'll invest another third. And then finally, if the S&P does fall to 2,800, which would be about 42% from last year's high, then I would invest the rest of my cash. I would then be all in on those long-term stocks, right? So you're not necessarily investing in the S&P 500 here. You're just using that as a marker for when to use that cash. It's a really stress-free way to know what you're going to do and when you're going to do it. So you're not stressing out over what the market is doing every day, wondering if you should put more cash into the stocks that are falling. Gives you those distinct markers on the S&P 500. If you hit those, you go in, you look at some of your favorite stocks, the stocks you already own, and those long-term picks, and you put more money in those at that level. Now, will any of those levels, so that 3,500, the 3,100, and the 2,800 on the S&P 500, will any of those be the stock market bottom, the exact bottom? Probably not. But what I want to do here is I want to be putting cash back to work for me. Okay, I want to be holding cash back until it gets to those points. But I also want to be putting it to work when when we do get those bigger sell-offs. Because again, the worst thing you can do is just to sell out of your stocks at a loss and then wait for the market to send any clear signals that we're back into a bull market, because by the time it does send those signals, we're back up already 15-20% or so, and you've missed out on a lot of the bull market run. Now I want to shift to our stock market update, what to watch this week, the stocks, the news I'm watching this week, and how it really guides the market going forward. Stocks just had one of their worst weeks last week, really the worst week since January, and it has only seen a larger drop in about 4 weeks over the last 3 years, and 3 of those were during the 2020 pandemic. So huge drop last week on that Friday sell-off on the CPI report. And it's interesting that whereas earlier in the year, a lot of the losses were exclusively in those tech stocks, the consumer discretionary stocks, the growth stocks, that's really metastasized, that's really spread to the broader market. And even now those old school industrial stocks in the Dow are getting hit hard. It's a bad sign. It's a very negative sign for the market that it's really the market-wide and investor sentiment that is selling out of these stocks. The volatility index, so the VIX, that fear gauge, spiked to 27, almost 28 last week, still below the 34 level reached on the market low in May, but I do believe that is going higher and the market is selling off more. Here we can look at the sectors to get that broad, that big picture idea of what stocks in each sector of the economy are doing. Again, we're at the sectorspider.com. That's sector and then spdr.com. Great tool they have here in this sector tracker. You can go to here to tools and then the sector tracker, change this time period for whatever time period you want to look at, and this is going to show you what stocks in each of the 11 sectors as well as the S&P 500 did over that period. So we're here 5 days, so look at what stocks did over the last week. And of course, all 11 stock sectors closed lower last week with really surprising similar losses. This is what we were just talking about, how it seems that negative investor sentiment and the losses have really spread evenly across the market. 7 of the 11 sectors finished between a loss of about 4.9% to 6.7%. So a very, very narrow range there, showing that it's no longer those growth stocks or the risky side of the market that's selling off, but the entire stock market. Consumer staples and utilities did offer some marginal safety there with just a 2.5% sell-off in consumer staples and 4% loss on the utilities. Of course, it was the energy stocks, again, that held up on support in those oil prices. Financial stocks in the financial sector, so insurance companies, banks, asset managers fell the steepest really on those recession fears and a flattening of the yield curve, okay? A trend that's probably likely going to continue over the next several weeks or months. Now, for what I'm watching this week, it's all coming down to the Federal Reserve when it wraps up that 2-day meeting on Wednesday, increases interest rates, releases new economic forecasts, and Chair Powell has a conference there. He'll talk to the markets, and it's difficult to see anything but bad news on the way for this. Okay, the central bank is going to wrap up. We've seen the market probability that market is unanimously expecting a 0.5%, so 50 basis point increase in rates. I actually do think there's a very good chance, a better chance, they'll go with that shock and awe of a 75 basis points or 0.75% increase in rates, just to send that strong signal to the market that, hey, look, inflation isn't coming down nearly as fast as we thought it would, that we said it would, and we are serious about tackling this inflation. That larger interest rate increase would be good for the economy because it would show that the Fed is serious about bringing down inflation, but it would most likely be bad for stocks because, of course, it's just confirming what I'm saying to you right now, that there's no way we're getting out of this without the Fed increasing interest rates so fast and so high that it's going to choke off economic growth and really send us into a recession. Friday's surprise increase in inflation really showed those price pressures are more persistent than the Fed expected and are not going anywhere without a very aggressive hike schedule. Again, Fed is also going to release new economic forecasts. It's likely going to show that the central bank members have come to that conclusion that rates are going to be higher. The interest rates are going to be higher than they expected previously, that inflation is going to be higher for a longer on that as well. And Chair Powell is going to give his briefing at 2:30 p.m. Eastern on Wednesday. And really the risks are to these that the size of the rate increase is higher, the forecasts for inflation and rates are higher, or that Powell just comes out and tries to talk aggressive, talk hawkish on these. So you got three scenarios that could send stocks lower, on the prospect for higher rates and a slower economy. Just a few stocks I'm watching this week. Earnings have pretty much wrapped up for most companies, though we still do have a few important stragglers here. Oracle, ticker ORCL, is going to report its earnings Monday and is expected to report $1.37 per share earnings. That would be 11% below earnings reported last year on revenue that's actually 4% higher. So we're seeing with even some of these technology and these software companies, these cloud service companies, that their revenues are higher, they're collecting the same amount or higher sales, but they're booking lower earnings because of those cost pressures, because of wages, because of their supply costs, and because of other costs. Competitor Cisco managed to beat its earnings for the quarter, but really at a smaller margin than it's usually reporting, and blamed that poor quarterly performance really on supply chain issues. So I think we probably hear the same thing from Oracle. I think it does beat its earnings expectations, but it's still going to be negative, especially on the outlook for the rest of the year. And even if you don't own shares of Oracle or some of these cloud services or enterprise companies, I think it's a really good signal on corporate IT spending, right? So watch what Oracle says about corporate IT spending, especially what they're expecting through the rest of the year, and whether companies are starting to scale back their enterprise spending and how that could affect economic growth, right? Because we're just now starting to see where companies are adjusting their expectations for the economy. That's going to bleed over first into their own spending for enterprise spending for these things like enterprise IT services. And of course, that's eventually going to affect their hiring decisions and the economy. Adobe, ticker ADBE, reports earnings on Thursday. It's expected to show a 9% increase in earnings, so pretty strong earnings increase for Adobe, expected to $3.31 a share compared to last year's quarter. But judging from the earnings reported by DocuSign last week, which were absolutely horrible, sent the stock down like 25%, I would be worried about Adobe here bringing up those same problems, right? Even after the sell-off this year, shares are still very expensive at 11 times on a price-to-sales basis for Adobe. And, if we hear anything like what we heard from DocuSign or a lot of these other companies that are reporting, especially if they come out and kind of warn or lower their outlook for the rest of the year, these shares could get hit hard. The Kroger company, so food groceries, ticker KR, also reports earnings on Thursday. It's expected to post an 8.4% increase in profits on sales growth of 6.8% during the quarter, which is absolutely huge for groceries, right? Normally, grocery stores do not report 8% year-over-year profit growth or almost 7% sales growth on the year. The grocery segment, though, has been one of the few areas of safety for investors, right? With Kroger is up 13% so far this year. Now, while inflation and supply chain issues are affecting the industry, grocers are finding that they're having better pricing power this year to pass on those costs to consumers than they did last year, right? We've talked about this with a lot of the consumer staples stocks, those food packaging, household products companies. Last year, they were getting hit hard by that inflation for their costs, their material costs. But consumers really weren't paying attention to inflation yet. They weren't expecting higher prices. So a lot of these companies, grocery stores, as well as the consumer staple stores, they were afraid of raising their prices because they were afraid that consumers just wouldn't take it. They would go somewhere else. This year, that's changed. Consumers are expecting higher prices. They're paying those higher prices. So these consumer staple stocks, especially the grocery stores, are raising their prices and seeing that they're able to pass on a lot of those costs to consumers. I'm also watching the broader market of Chinese stocks, right? It really bucked the downtrend last week with the iShares China Large Cap ETF, that ticker FXI, was up 2.7% through the week last week on really news that the regulatory clampdown on tech stocks might be over. They're also having started the economic slowdown last year in China. So China's central bank, their federal government, is really on a different path from the rest of the world. They're lowering interest rates. They're injecting that monetary stimulus and fiscal stimulus to boost the economy. So I think that really could further support stocks versus other markets. So we will see kind of a divergence in Chinese stocks heading higher, whereas the U.S. and European stocks could continue to head lower. Don't forget to sign up for the Bowtie Weekly, our weekly newsletter, with the link I'll leave in the description. Click on the video to the right for that iBonds video, really the best investing opportunity for investors right now. Get that 10% return, guaranteed return on savings bonds, and protect your money over the next year.